I had an aha moment about 6 months ago. One of those moments where you're like, I was looking at the Cambridge benchmarking and we were doing something with it, and I was like, looked at it and I noticed that for a vintage that was like, 6 or 7 years old, there was only 42 funds in the Cambridge benchmark. And I was like, we got like 100 funds that are going to apply to Springboard. That's a lot of data. What can we learn from taking the data from Springboard, from all those applicants, and trying to aggregate it up and get some insight into the universe in which you are actually operating competitively, and how are you appearing compared to your other similar firms? Because I feel like the plight of the emerging manager is always this: how am I doing? The benchmarking data in venture capital is kind of useless. You got two sources: Cambridge, which gets a lot of big funds in it, a lot of brand name funds in it, and they have great access, and that's one particular viewpoint. You have Preqin, which is the other data source, a great sponsor, by the way, and they gave me access to like their entire database for like the last 3 months, and I've just been pounding away at it, finding a lot of great insights. Preqin gets its data only from doing FOIA requests, so that it's mostly like you have to have had a pension fund as an LP in order to end up in Preqin, right? They also have a lot of fund of funds, because the fund of funds, actually the people who get the, they're the ones that a lot of times act as sort of blockers between the pensions and the big brand name LPs. So you have these two data sources that are very biased and very limited in their own way. The Springboard presentations, what did we have? We had 89 funds that applied to present. We had 82 funds that filled out a short survey as part of the registration that asked basic things about like, hey, when did you start fundraising for the first time? How much assets do you have under management? Just some basic stuff. And 79 presented an actual fundraising deck that had a varying range of track record data in it. And that data, the biggest problem I faced in doing this is that there is a lack of standardization about how people report their track records. Some people will just be like, Fund 1's a 2.5x. I'd be like, I have no idea what that means. Is that total value to paid in capital? Is that a multiple of invested capital? Is that net? Is that gross? You're not telling me anything. And those we kind of had to ignore. But we did end up getting 62 solid numbers for Springboard applicants in terms of their performance in their funds, that we felt like I had a clear enough footnote that I could rely on the data. And what it shows you is that the people here are doing a hell of a lot better in their track records than the industry at large. Median TVPI, 2.3x. Top quartile TVPI, 3.7x. And that just blows away the Cambridge benchmarks for 2014 or the Preqin custom benchmarks. Now, the Preqin custom benchmark, literally what I did was, and you can do this in Preqin, is you can go like select specific funds. So this is like True Ventures and Greycroft and like really good names you would know for 2015. It's a small number, it's only 15 funds that I felt were really relevant, and that's the problem with Preqin. But it gives you some really interesting data. Now, I'm not ready to say what this means, but it is to say that when you're all going around saying, hey, we're a top quartile fund, because you're comparing yourself to the Cambridge benchmarks and the Preqin benchmarks, you're all top quartile, congratulations. But you're competing with each other in a lot of ways, and that is only one part of the story. So what other kinds of data could we get out of this? Well, what I realized was that there was a lot of different types of track record information that was in the decks for emerging managers. Number one, you had the angel investor who does great, and he's like, whoa, man, this making money thing is awesome. I'm going to turn this into my regular business. That's one type. Then you had GPs who had their own track records that they were like, I did great at this firm, but I hate it here, and now I'm going to go do it by myself. And then, of course, you have a different mixed grab bag of firms that have come together in different ways. So to give you a sense, we actually we had 11 complete angel track records, and we added them up. And the angel, people are using their angel track record. They are killing it. I mean, my God. The median is 9.9x. So when you're thinking like, man, I'm an awesome angel, I got 5x. I mean, like, yeah, not so good. Your top quartile, 12.4. There was one that's like 30-something, all right, in there. Veteran GP performance, I think, was more interesting. Those track records are harder to tell what they really mean. You have to get into really knotty questions on attribution. You get concerns about cherry picking, how are you going to diligence it. It's much harder to tell what's real. If you've been at a firm for like 20 years and you only show 10 funds in your track record, it's kind of like a red flag. And so there you see the performance again, median 2.5x, top quartile 5x. 5x, man, it's amazing track records. We were able to get 40 fund ones. And again, you see and these are of varying vintages, so it's not totally fair. And by the way, you guys can stop taking pictures because I will give you all these slides. And so we have TVPI of 2.0 is the median, top quartile of 2.7x for fund ones, multiple of invested capital, so that's gross and ignoring this little naughty thing called fees, 2.3x and 2.8. Fund 2 performance, these are super young, 1.4 and 1.8, so you can't really do much with that, I don't think. Now, who are all you people? And no surprise, the Bay Area seems to, because we're here and there's this huge amount of bias here, it seems to dominate. And the vast majority are on your second fund or more. So if you're in your first fund and you're even here, you're ahead of the game. When we did Springboard, we actually only ended up putting up really one true first-time fund, which shows that there's there's a gap here that needs to be filled. So number of companies. How many companies in their portfolio? Huge division between I get involved early, I get big ownership stakes, or I'm like, whoa, the 500 startups super diversified. Median, half the funds had less than 20 companies in their portfolios. But to get to the top decile, you had to have 80. Huge division there. Assets under management, the vast majority are really still pretty small, 15 million and under for the median. Top decile, 60, biggest fund here, 267. This is really interesting. What's the percentage of funds who have ever made a distribution that applied to Springboard? 15%. So if you're one of those funds, you're distinguishing yourself there. What number of funds have a DPI? Any fund out of the 62 that we looked at have a DPI above 1. 7.9%, so it's like 2 of them. Now this is some good news. If that's bad news, this is good news. Partnership breakdown. You see, we typically think the 2 GP funds are the most common, but the partnership diversity was what I found was the most exciting looking at all the decks. Of all these Springboard applicants, we looked at all the GPs, we sat there and counted. 41.6% of the funds had a female GP. Compare that to the average overall. And 53.7% either had a female GP or were diverse in another way. Okay? That means that the white male funds are down to 43% market share. It's a big improvement over the rest of the industry. And like I said, the people here are a leading indicator on where this industry is going. Fees and terms. Super interesting. We took all the fees out because everyone had their decks. It was like, these are our fees. We're like, okay. Your typical things, 2.5% with a taper. They were very unclear about exactly how the tapers worked. But 55% had some kind of break on those fee structures. Something was different about it that made a lower fee structure overall. And only about 19.6 were fees that were above. 5.6% of the funds had a preferred return, which I thought was really low, meaning that the LPs get 10% before there's any carry. Really common if you have big institutional investors that they're going to require that. And only 13% had premium carried interest. So relatively small number. This annoys people. I did not go back to check, does the track record warrant the premium carried interest? But just know that's the percentage. Fund market size, the vast majority of funds between 25 and 100 million takes up the vast majority. Still a very good chunk, less than 25 million. But it sounds small, but if you add it all up, the numbers get big pretty fast. We added up all the funds raised by the Springboard applicants since inception, 2.3 billion. If they all hit their fundraising targets that they have on their book, they would raise this year, because 90% of them are in market now, $4.1 billion of capital demand just here at this conference. Now, there's always a question of, hey, how much are we going to raise? We're a $25 million fund. Should we go to 100? Should we go to 125? The average increase is 3 times on average. This I thought was super interesting. we looked at the percentage of funds who have had a first close that were part of the Springboard applicants. Now, that's a huge affirmation that this thing is real. You've already had a close, it's half the fund. 21.3% of the applicants had already had a first close. And a very common strategy to get to that first close is to contribute some assets to the fund in some way, either by doing somebody's warehousing a deal or you're taking assets and putting them in the fund. And fully 24.7% of the funds had contributed assets. Clearly, funds by stage, it's a seed game. I was so happy that no one said we're a pre-seed fund. I was just waiting for that. Primary source of funds. Vastly majority, the family office and high net worth individuals totally dominate. And this is important if you're out there thinking about fundraising, because we spend a lot of time schmoozing other types of investors. But it might be better just building a $50 million fund on the back of $500,000 commitments and just hitting the road. That may be the better strategy, because clearly it's hard to raise from the bigger institutions. Finally, I wanted to come up with one measure that applied to every fund. And I've never seen this anywhere before, so you got to bear with me for a second. What I wanted to say was, the only thing that you know as an emerging manager is, like, am I raising money or not at this stage? Like, no one's just, you got little markups here and there. But the one thing that distinguishes firms are, have you raised money or you haven't? So what we did was I took the total amount of assets under management, and I divided it by the number of years that fund was in business when they started, to get to a measure of how much money have you raised per year. Because this is something that at least you can say, I've been at it 3 years. Well, according to this, the median fund would have raised about $20 million after 3 years. So if you're 40, you're like, hey, we're doing all right. If you're 10, you're like, ugh, got to figure out what's going on. The second one really blew my mind, because I thought for sure that the single GP phenomenon, that they would have a harder time, because how many LPs have said to me, like, ugh, I don't know if I can do it, it's just a single GP. Like, what happens if he gets hit by a truck, or what happens, right? They do better. I can't explain this. Like, I double-checked the data. I was like, something's wrong. But they do better, and I don't know why. Finally, also, I thought thematic funds, given the interests of the LPs, would do better than generalist funds. Now, Samir didn't totally define it. If you listed more than 2 things of your investment interests in your fund, if you're like, we do AI, and we do robotics, and we do frontier technology, you're like, you're a generalist. Like, I want, like, we do synthetic biology, and that is it. That's a thematic fund. So we were pretty tight on this. And thematic funds raise money slower than generalists, which again, totally counterintuitive. I literally went back and had to double check the data because I was so surprised. Finally, so I think that's super interesting, I wanted to give you a sense of the long-term performance of the asset class, because as I was banging away at this Preqin database, I've been in this industry for 20 years, and I've never looked and said, how do venture capital funds really do out there in the world given enough time? Okay, so what I did was, another point is, like, the problem with these benchmarks is there's so few funds in them if you look at it individually at vintages. So I decided to start grouping vintages together and looking at big pools of fund on a global basis to see how funds produce over a period of years. So my first analysis I did was I took 225 total venture capital funds out of Preqin. So these are all funds that have pension money in them. And I said, what percentage of these funds have delivered a DPI higher than 1 after 8 to 10 years? Okay, so for $1 in, the VC fund has gotten $1 out. And I was just shocked. I've been talking to other people aren't shocked as I am, but like the answer is 23.6%. Only 23.6% of venture capital funds have delivered capital back after 8 to 10 years. We have a liquidity problem. Now, looking at unrealized gains from these funds, what percentage of funds have a net multiple, so now we're at TVPI land, of between 2 and 3? Only 14.7. What percent have a net multiple greater than 3? 6.2%. That is how hard it is to actually deliver a 3x fund. Sit with that one for a moment. So then I said, well, I had seen like at least 4 or 5 decks that had said, this is fund 1, and then they just sort of like put on their projected 5x. And I thought of this, and I thought to myself, what percentage of funds have ever hit a 5x? So I actually went back all the way to 2006. 2006, that I had 985 funds. And you want to produce a 5x fund out of 985 funds. Only 10. And by the way, you better be in China, because there's only 4 of them that are domestic. So finally, I want to give you some thoughts, some really practical things. It's amazing, because I'm a GP, I'm not an LP, although I'm making more and more fund investments these days as I meet the great people here. But what really stood out from the crowd? Like, I've read 200 decks now in the last 3 years. And there's some themes with me, and this is just my opinion. I'm sure if you ask Courtney McRae, who's my partner on Springboard, she'd say different things, but I would say number 1 is just professionalism in your deck and track record. If you're sloppy about how you report, if you're sloppy about how you lay out your track record, it's hard for me to take you very seriously. There are standard ways you do this, and it's just a huge red flag to me that you're not taking this like a serious investment business. Contributing assets to the fund is awesome. I mean, you can actually look at some of the deals you're getting and be like, you can dive into them and be like, I'm going to have exposure to these. It makes you feel like a primary investor, which is what a lot of LPs want to feel like. Finally, additionally, what's your unfair competitive advantage? I'm going to actually call out 2 of the most successful firms that have come through RAISE, because, what's your unfair competitive advantages? Where is your source of deals? It can't just, you have to be more than just a smart person running around Silicon Valley with a deck and some fancy advisors and some quotes from them, because everyone has that. When I think of like what Fifth Wall has done with their LPs in real estate tech, unbelievable. When I think of what Jazz Venture Partners has done with the conference that they have all around neuroscience, unbelievable in terms of creating a real competitive advantage. And that's what a competitive advantage looks like. And when you see it in a deck, you go, I want that. So think about how are you going to build your unfair competitive advantage. Finally, GP biographies, these funds last for 15 years. You're in partnership for a very long time. And a lot of funds do not do a good job of saying, like, who am I and what have I done before and why is that leading me to this? Ownership. So few funds really focus in on how much ownership they have. There's way too many funds who are spread out among too many companies where the size of exit that they have make it very hard to think that you're going to make money. And that's something that when it's there, if you have good ownership and you have good stories, you should bring that out. Finally, case studies. I cannot stand the slides that are in these decks that just have a logo of your co-investors. They're in every deck, and they are useless. What I like is, and a bunch of you did this, I invested in this date, I met this entrepreneur this way, we did these three things, and then we raised from benchmark at a 2x, or Sequoia, or whatever. Then you're like, you're leaning in. That is the way to present your co-investor information, okay? And if you do those things, you're going to really stand out, and I think that's a great thing. But in general, I would say I'm just totally amazed by the quality of people here, and I'm so excited for the rest of the day.